Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today again with our co-host, Nick Ward. Nick, it's good to see you today.
Thanks for having me, Brad. Glad to be back. I thought today might be the day I get to shave my beard. I said this was the playoff beard. I'll keep it as long as the rally goes. We got a headline yesterday that we'll be discussing in just a minute about the U.S. credit being downgraded. I thought that'd be a big sell-off this morning, and my wife would finally like the way that my face looks again. But here we are. We're in the green again.
Yep, that's good to see. And so I just actually finished our Wide Moat Daily article. By the way, you can sign up for Wide Moat Daily by going to widemoatresearch.com. But I just finished our daily content, my daily article, and talking about Moody's. And really, it's much ado about nothing here. I mean, we've already, Fitch and S&P have already downgraded. So to me, it was not, as a knee-jerk kind of reaction. Obviously, credit ratings are important. We'll be talking about that here shortly in just a minute. But Nick, overall, what are your thoughts on the Moody's move?
Yeah, no, I agree. I always have, I sell puts for some extra income. So I had those kind of over the weekend, and I saw some big red numbers in the futures late last night, and I was a little worried I'd be kind of put some shares I didn't necessarily want to own, but, we're rallying today, and I was surprised, right? I don't, like you said, much to do about nothing. I looked up some numbers in 2011 when S&P first downgraded the U.S. from AAA down, that the market sold off 6.5% on that day. So that was obviously a major sell-off. That was a surprise to everyone. A few years later, Fitch downgraded. I looked it up. The market was only down 1.4% that day. So a little bit less of a surprise. So at this point in time, everybody kind of knows all the issues that the U.S. government's having from a fiscal standpoint. So I'm not surprised to see what the market was down 1% when we opened today. And I think as we're filming now, the Dow is actually back into the green. So we're looking past this one, towards tax cuts right now.
Yeah, look, USA is the gold standard. And we've seen a number of commitments made here in the U.S. And one of these companies we're going to be talking about here in just a minute. I'll go ahead and let the cat out of the bag. That's Apple. Apple has committed $500 billion. NVIDIA's committed $500 billion. SoftBank, OpenAI, and Oracle at $500 billion. IBM, $150 billion. The list goes on and on. Johnson & Johnson, $55 billion. So it's really clear that there is a massive move towards investment in the U.S. And Apple, as I alluded to earlier, is certainly one of those companies that's made significant investments within the U.S., as well as the second company that I will be talking about. So what Nick and I decided we would do this week, and we talked about a little bit on last week's show, is we're going to pick, Nick's going to have his really most popular, one of the most popular tickers that he hears about. And one of the most popular tickers or companies that I hear about frequently. We thought we would both do a kind of a deep dive real quickly on each of those tickers. So Nick, I'm going to let you start it off. I've already, again, let the cat out of the bag with Apple. Apple is certainly a very popular name, and I know you know a lot about Apple, and we've covered Apple quite a bit here at Wide Moat Research. So I'm excited to hear your take.
Yeah, last week we said, hey, leave a comment in the comment section of our video with some suggestions on what to pick. I think a couple people named Apple, and I was happy to kind of run with that. This is actually today. Broadcom's up 2%, Apple's down a little bit. So Broadcom surpassed Apple as my largest holding as of 9:52 this morning. But pretty much for the last decade, Apple has been my largest holding. I've followed this company very closely. And that's why I'm wearing this shirt today. I'm doing my best Danny Ives impersonation while I break down a tech stock for you guys. So, I didn't have a pink blazer to go with the floral shirt, but I did have the floral shirt. So, Danny, if you're watching, and all the guys from Wedbush, this is Wide Moat kind of tipping our hats to you. I like Apple a lot. Like I said, I've owned it, but I think I view it through a different lens than a lot of other people. I think a lot of people think of Apple and they think technology. You think iPhone, you think iPad, MacBook computers, whatever. But that's not how I view it anymore. I used to. When I first bought it, Apple was basically like a high growth tech company. It was actually a deep value. I bought it at on a split adjusted basis. I think my cost basis is right around $20 a share. So it's been a big winner for me. At the time, it was only trading for 12 times earnings. Now the stock is trading, I'm looking at, it's above 30 times earnings. So we've seen a massive multiple expansion. And that's what I think a lot of kind of the Apple haters talk about. They say, hey, this is a tech company with a 30 PE, which isn't all that uncommon. But the difference between Apple and many of these other companies that are trading with such a high multiple is that Apple is not a fast grower anymore. It's a very mature company. There's a piece in Bloomberg this morning talking about how they're kind of lagging behind on the AI and what are they going to do about it? What does that mean for the company? It's not hard to find kind of hit pieces on Apple, but that's because you're comparing it to all the other technology companies. But what I do instead is I compare it to consumer staples companies, because at this point in time, that's what I think Apple is basically the iPhone is like the Coca-Cola of the 21st century. You can't be without it. And that's not going to change. I don't see that changing anytime soon.
Nick, I'll say one thing. I've learned a lot, obviously reading a lot of your research on Apple. And what's really interesting, and by the way, I do have a new Apple Watch here.
Hey, that's what Apple does, right? They enter a new category, then they win it, right? Brad's got the watch on. 5 years ago, Apple wasn't selling watches, right? Or they had just started. So now they have billions of them out there.
Yeah, and what's really interesting, Nick, is the custom chips. I saw somebody post a video on X a couple of days ago, just talking about they went into kind of the microscopic level of these custom chips, and it's just amazing to see the advancement and the evolution I know that Apple has made in the chip space.
Yeah, people say, obviously Steve Jobs is like a visionary, a genius of our time. Everybody references him when you talk about visionaries, and people love to say Tim Cook, the current CEO of Apple, is not a visionary, that he hasn't really done anything new. All he does is just manage Steve's vision. But I don't think that's true. Like you said, they used to kind of have to outsource all these chips. Now they're making a lot of the components of their hardware in-house. When they do that, they're controlling their supply chain better. They're getting better margins. So I think that's like Tim Cook's expertise. He took the iPhone and he made it so much more profitable than anybody could imagine. Now they're doing that with all their other hardware. And then obviously the services thing, the government hates it. A lot of the DOJ we're seeing, people don't think it's fair that Apple has, if you put an app or anything on an iPhone, you have to pay Apple, I think 30% of your revenue. People don't like that business model. I love that business model, right? And I think Apple deserves it. If you want to go put your app on someplace else, go do it, right? But if you want access to Apple's, 2 billion active users across the world, you ought to have to pay for that. I think Apple developed that. They spent, hundreds of billions of dollars to develop that network, that kind of ecosystem, and now they get to be the beneficiary. So I'm not that worried about the lawsuits. And like I said, I compare it to consumer staples. So what I want to do is kind of just throw up some charts on the page just to kind of put you guys in that mindset. Here's Apple's chart, 10-year chart. I'm looking down at it to explain it. Like I said, 31 times PE. You do see the average PE over the last 10 years is 21 and a half times. So they look overvalued. Now I'm going to change it to a 5-year chart, and you'll see we're actually about in line. Over the last 5 years, ever since COVID, I think this revolution has happened where people are realizing this is a very mature company. It shouldn't be viewed through this kind of disruptive tech lens. It's more of a consumer staple. And then let's compare this chart that you can see now to some of the most popular consumer staple companies out there. So here we have Church & Dwight, who sells condoms. Those are never going to go out of style, and soaps and things like that. So everything you need. Look, their average, they're trading for 28 times right now, 27.7 times. That's not that much different than Apple, and they're growing at mid-single digits, 1.76%. If you looked at the Apple chart, they're down at they're expected 9-10% growth moving forward. So what would you rather do? Have pay a little more for 10% growth, pay a little less for like 5% growth? Here's Procter Gamble, dish detergents, washing machines, soap, things like that. Everybody, probably your house is full of these types of products. They're trading for 24 times. Here's another chart, Colgate Palmolive, toothpaste and toothbrushes. Everybody needs to do that. They're trading for 25 times. And then lastly, I want to show up something else, probably one of the most boring companies in the world, Walmart. Just massive revenues, very low margins because they sell things very cheaply at a low price. They're trading for 38 times right now. So would you rather have Walmart trading for 38 times or Apple trading for 30 times? To me, it's Apple, right? I mean, and I'm happy to pay that. I think 25 times is kind of fair on this chart. Here's the 10-year Apple chart again. The pink line is 25 times. You'll kind of see that's where my fair value kind of is for the company. On a forward-looking basis, we're talking about $180 per share. So yes, I do think Apple is overvalued right now, but I'm very happy to hold it. And kind of here's why. This is just what sums up my argument. This is why I think Apple is the ultimate kind of sleep well at night stock, is here's what the company has done with their shareholder returns since Tim Cook kind of took over. Like, remember, people love to hate Tim Cook, but I'm not sure you're going to hate him after you look at this chart. They have returned nearly $1 trillion to shareholders since 2012. That's amazing. If you look at this chart, you can see their cash on the right, their debt on the right, and their net cash. So Apple, a long time ago, said they want to take their massive cash pile and return it all to shareholders and get to kind of net even when it comes to cash and debt. They're almost there. They used to have $153 billion surplus, $100 billion surplus. Now they're just down to $35 billion. And they're returning massive dividends to shareholders. Yes, it's a slow growing, and yes, the yield is low, but that's because the share price has moved up so much. And they buy back, I think something like, 6 to 8% of their share count a year. It's massive. So, no other company is spending this much money on shareholder returns. So I'm very happy just to sit back, own the shares, own the company. I don't worry about disruption. I focus on these shareholder returns.
Nick, I love that. And I really love the comparison that you make with these other consumer staples company. I think that's really legitimate. And a lot of people don't really understand that. They view this through a lot different lens. And I think it's really good to show those multiples with those other companies that you mentioned.
Yeah. I mean, just imagine going throughout your day without your phone, right? You can't do it. In this day and age, your phone is just as important as your toothpaste. And I don't think that's going to change anytime soon.
Absolutely. Well, so I know Apple's got I think a AA plus. Is that AA plus or AA?
Yeah, I mean it's almost as good as it gets, right? Like we've said, Microsoft and Johnson & Johnson have the AAA. That is as good as it gets. But yeah, Apple is just one peg below that at AA plus, and so their borrowing costs are minuscule. They can go do whatever they want to do with their cash. They basically just choose to return most of it to their shareholders.
Great. Well, my pick is another high quality company, Blackstone. And again, I'm going to warn you, I'm not going to be talking about REITs today, but I'm going to talk about a REIT aggregator, a consolidator, potentially. So Blackstone has a good credit rating, A plus, not as good as Apple, but certainly A plus is very solid balance sheet. A few years back, I wrote an article. I got a screenshot here. I'll show you. I think it was around 2022 or something like that, about 3 years ago. I wrote an article called My Quest for the Best Asset Managers. So Blackstone is what we would consider to be an asset manager. They aggregate assets. They're more of what I would call asset heavy. They're asset light managers as well. So some of the peers or the competitors for Blackstone would be companies like BlackRock. I'm going to pull this up here. BlackRock has $163 billion enterprise value. Everybody's heard of BlackRock. Dividend yield 2.1%. We find BlackRock fairly valued today, as shown here on this chart. They're trading at about 22.3 times. The next chart I'm going to pull up, which is another asset light competitor of Blackstone, is T. Rowe Price. Ticker is TROW. $20.5 billion enterprise value. Dividend yield is 5.2%. That one is trading fairly cheap right now, 10.9%. Normal value is about 18.6 times. And by the way, we cover a lot of these asset managers here at Wide Moat Research. Another competitor is Invesco. Again, another asset light business model, about $5.4 billion enterprise value. Again, they're trading fairly cheaply today at about 9.1 times, as you can see on this chart here.
And they're cheap for a reason, right? They're cheap for a reason because BlackRock is just taking all the market share, right? So that's why. And I think you're going to get to this, right? So that's a tough business to be in. You either have the good ETFs or you don't. But it's different when you invest in real property.
Yeah, and absolutely. And that's the scale advantage. And kind of going to the next pick, and this is more of what I would call an asset heavy model. They own a lot of real estate, and that's companies like, the next chart I'm going to show you is Cohen and Steers. I actually know the co-founders, Marty Cohen and Bob Steers. They both wrote testimonials for several of my REIT books. Cohen and Steers has an enterprise value of about $4.5 billion. Dividend yield is 3%. And again, they're a little pricey today, as you can see with this chart. They're trading at about 28 times versus their normal valuation of about 22.8 times. And then KKR is another really more direct competitor. Again, private equity shop, but again, they have about $188 billion enterprise value. Very modest, very puny dividend yield of less than 1%, and a PE of 25.8 times. So definitely expensive today. And then we move on to Blackstone. This is the company that I'm really wanted to talk about today. Blackstock is one of the largest alternative asset managers in the world. They've got $1 trillion of assets under management. So extremely big company, continuing to grow and take advantage of that scale and cost of capital advantage. I mentioned the rating they have. They're trading at a 31 multiple today, which again could be pricey compared to historical. But as Nick pointed out with his previous pick with Apple, when you look at it on like a 5-year basis and really the evolution of Blackstone over the last decade or longer has really been enormous. Now, one of the things that I wrote about with Blackstone in 2019, and this was a catalyst that I felt like it was going to take place, and it certainly has. And that's how when the company moved from a K1 investment into a C Corp investment. So that allowed them to remove a lot of the kind of overhang with investors. They didn't have these K1 agreements, which are really complex for a lot of investors to have those. And they also got rid of the ECI, which is the effective connected income, as well as UBTI, which is referred to as unrelated business income tax. So made it a lot simpler business model, and the retail investors just ate it up. And that was really a catalyst that really started to spark this growth that we saw, enormous price appreciation. Again, from the cost of capital advantage, we just went through the latest earnings results, and Blackstone has $180 billion of dry powder to deploy. So that's a significant amount, which means we're going to see the company continue to take advantage of opportunities. Now, one of the things that has really given us a competitive advantage here at Wide Moat Research is we cover a lot of these companies. There's a lot of real estate investment trusts or REITs that we used to cover, but Blackstone bought them. And companies like PS Business Parks, which is a $7.6 billion investment that Blackstone made, Preferred Apartment Communities, $5.8 billion, American Campus, $13 billion, Retail Opportunity Investment Corp, $4 billion, QTS Realty, they were based in Atlanta, $10 billion. The list goes on and on. So Excel Trust, which is a retail REIT, Hospitality, Biomed, which is a life science REIT that, again, Blackstone acquired and took private at $14.6 billion. So what I see is that trend continuing. They've got this war chest of capital, and I'm going to provide you today with a couple companies that we cover that we think could be logical takeout targets for Blackstone. This is important. So you kind of get a two for today. We're going to tell you about Blackstone, but I'm going to give you a handful of REITs that I think could be potential takeover targets. And this is really important. So take notes. CenterSpace, ticker symbol is CSR. Now, CenterSpace, we cover the company here at Wide Moat Research, $2.3 billion total capitalization. So relatively small company in Blackstone's world. They have 13,000 apartment complexes spread around the country. And you can see here on the chart, they're mostly in the Midwest market. So it's a real tactical opportunity for them. There's a lot of really good affordable housing in the Midwest, and that's the market that they focus on. Now I'm going to show you a fast graph here. You can see right now CenterSpace is trading at about a $1.1 billion market cap. Multiple is 15.1 times. Normal multiple is about 20 times. So you can certainly see that wide margin of safety, about a 5% dividend yield. Again, good company to buy, but also I wonder if Blackstone's watching this video. If they aren't, they should, because I think Blackstone could be a really good opportunity. CenterSpace could be a really good opportunity for Blackstone. The second pick I want to go into is Lexington Industrial. That's a $2.3 billion warehouse REIT, mostly warehouses. Now, we've watched the evolution of Lexington over the last decade or so. They've kind of gone through it. They used to own a lot of different types of properties. They've really migrated away from office and focused primarily on industrial. They've got about 118 warehouses, as you can see on this chart. 91% of those are what we consider to be Class A type warehouses. So as the next chart shows, Lexington, again, is trading at a margin of safety, about a $2.4 billion market cap. And that's easily digestible for Blackstone. The current multiple is 14.5 times. Normal is about 16 times. Dividend yield is 6.4%. And if you can see here on the bottom right of this chart, you can see the growth prospects of this company well. So certainly we're seeing, based on analyst estimates, even some low double-digit growth ahead. I'm going to try to get to two more picks. The next one is Kite Realty. Kite is a company that we cover here at Wide Moat. $4.8 billion market cap. Company was founded in 1960, primarily Sunbelt focused markets. You can see here on this chart here. And again, the reason we think Blackstone could take a look at this company is valuation. They're trading at about 13.3 times. Normal, that's about 16 times. Blackstone has acquired several other shopping center REITs here over the last few years. So we think Kite could be an interesting takeover. And last but not least, and I hate to let this one go. I'd hate for the company to go private because they're a great public REIT, and a little known REIT really close to me in the Southeast is EastGroup. That ticker symbol is EGP. Now, a good bit larger than some of the others that I mentioned. They're about an $8.6 billion market cap. You can see the map here. They're primarily, again, very similar to Kite. They're kind of up and down the smiley states, as I refer to it, from the Carolinas all the way down into Florida, into Texas, all the way to California. And they focus on these kind of infill, I call flex space properties. So these are smaller warehouses that have multiple tenants. I think this would be a great strategic opportunity for Blackstone. They have already acquired PSB Business Park, which is a company that we recommended and did go private with Blackstone. Our investors made a lot of money off that trade. And again, EastGroup, I think, could be another really interesting play. Market cap, again, of about 8 billion roughly, and trading at a multiple about 25 times. The normal multiple is about 32. Definitely see a margin of safety. And again, those are some picks. So I guess the bottom line is Blackstone is a consolidator of not only real estate. They offer hedge funds. They have infrastructure. I mentioned data centers. They own a very large, very wide portfolio. They invest in companies and opcos as well. So really like Blackstone a lot. And again, I think much like Apple, they have that cost advantage and they have that scale advantage. And again, we picked this one at the right time. It's done really, really well. Now, I did some checking before I jumped on with you, Nick. And if you go back over a long period of time, Apple has considerably outperformed Blackstone by almost 10 times, something like 400% to 4,000%. But I will tell you, over the last 6 months and even year, Blackstone has outperformed Apple. So certainly both of these are very high quality picks. And Nick, I'm glad we were able to discuss two of our favorites here today.
Yeah, no, happy to break these down. I really like the asset manager space because, like you said, that they can buy. You just proved they can buy anything, right? They're buying all sorts of real estate, all sorts of companies. They do private debt. They do all sorts of things. So when the market's volatile, some of the smartest people in the world work at Blackstone. I feel pretty confident just letting them make the decisions. It's so hard to be a value investor all the time. Most people don't have the time to do the research. Well, if you just buy, ticker symbol BX, they're going to be taking advantage of this volatility. Like you said, they have almost $200 billion of dry powder. If they need more, they can go find it. There's no shortage of people looking to kind of raise funds for alternative assets. That's expected to be a massive growth area over the next kind of decade. And I like this company a lot. I will note they do pay, unlike so many of the companies that we follow here at Moat Research, Blackstone pays a variable dividend. So their dividend is based upon how successful that quarter was as far as cash flows go. And that changes because this company buys all these things like Brad talks about. And then some of them they just hold on to for a long time and make money with, but also they're trying to sell them as well. So on the quarters where they exit a lot of their investments, they can return more cash to shareholders. So don't expect that perfect like stair-step pattern higher dividend that we typically like to see, like Apple pays, for instance. Blackstone's dividend is going to go up and down. You're going to see headlines, Blackstone cut the dividend by 26%. But don't be scared. They didn't actually cut it. It's just it changes every quarter. And over the long term, it is headed higher. And I think that trend's going to continue.
Yeah, well, it is. I mean, analyst estimates, and there's a big analyst pool. I'm looking at a screen right now with 21 analysts covering this company. In 26, the average consensus number is 33% growth in 26. And going out to 27, I've got 8 analysts looking at that number, and there's about 23% growth forecast for those analysts. So if you just kind of back of the napkin, this company still has, even though, again, if you look at historical standards, it's a little pricey. But look, I still think it's a great opportunity today. And much like Apple, I don't think I'm interested in selling any of these shares. And again, the only bad thing about Blackstone is they're taking away a lot of my REITs that we like to cover. But at any rate, Blackstone is definitely a great company, and so is Apple, Nick. And I appreciate your overview of this company.
Yeah, no, thankful for the subscriber that asked the question. Like I said, Apple's near and dear to my heart. It certainly changed my life, and I'm sure that's the case for many other people moving forward. So I think Brad and I might continue to do these. It'll depend on how many people watch the video, how many likes we get, subscribes, etc. But if you guys like these kind of single stock breakdown videos, please let us know in the comment section, and let us know which other companies you'd be interested in kind of hearing these analyze out loud videos from.
Great. Well, thank you everyone for watching the Wide Moat Show today. Look forward to seeing you next week. Drop us some comments below, like us, and subscribe to our channel. We really appreciate it. Have a great week, everyone.
Yeah, have a great week. Thank you.
Thank you for watching the Wide Moat Show. Don't forget to like, subscribe, and comment below. Also, please subscribe to thewidemoatdaily.com. I'll be sending out one free copy of my REIT for Dummies book every single week for those who comment below. Only one per week. Thank you for watching and being part of the Wide Moat Show community.